Hey, so for these videos, which there might just be one of, because I don't have much time, but we're trying this format where I am explaining stuff that I've explained to clients way too many times, that I think can benefit you in understanding how you pay or do not pay your taxes in Canada. This is unscripted, unplanned, and just 10 minutes of time I don't have. But hey, you're not paying me $360 an hour for that. So good advice. So what happens in Canada when you die, you ask? Well, the official answer is there is no death tax in Canada. So dying is not a taxable event. So you don't pay taxes by virtue of the fact that you have died. That's unlike countries like the United States, where you do have a death tax. They call it an estate tax. Basically, the estate is the money that you have when you die that is taxed, right, as it's transferred to someone. We don't have that in Canada, right? Really, in the United States, though, there's an exemption. It's pretty high, so most people end up not paying that tax anyway. So in Canada, we don't have that, but we kind of do, right? So we don't have an estate tax, but what we do have is what we called deemed disposition of assets, which affects essentially the same thing. So when you die in Canada, the fact that you are transferring your money to, say, your kids is not in itself taxable. Usually that's supposed to be logical, because most of the money that you are transferring is money that you've already paid taxes on. And usually you only pay taxes on stuff once. So if you make $1 million, you save up $1 million, that is money that you have saved up, right? Simplifying things, after you've paid the taxes on it, assuming it's not, in a registered retirement plan, which has somewhat different rules. But your money, right, say the money is in your house or whatever, or your bank account, is money that you've already paid taxes on. It is incoherent for the government to tax you on that money, whatever they call it, right? Whether it's the fact that you're transferring it or something else, right? Not coherent for the government to tax you on that, because they've already done it. And generally, again, you don't get taxed twice. But, we have a problem with wealth inequality. Wealthy people get exponentially richer. You can take away as much as you want when they die. They just get exponentially richer anyway. That's kind of the problem, at least in the eyes of the government. Some of my clients might not agree with that. But it's a problem in the eyes of the government. So the government taxes you when you die through what we call deemed dispossession. So it doesn't tax the death or the estate, but it creates a legal fiction through which you are deemed to have disposed of your assets. And that means what it says, right? A disposition is a sale, and deemed is they made it up. So they make up that you have sold your stuff. In other words, you've got $1 million in a bank account, which again, otherwise you can do whatever you want with it, right? Because you pay taxes on it. You can buy whatever. You don't have to ask the government for permission. You can send it to Switzerland if you want, as long as you don't hide the proceeds. So send that to Switzerland if you want, right? When you die, you've got the $1 million. The government says it's as though you sold your $1 million for $1 million. Now, of course, in actuality, nothing happened, right? You didn't sell it to anyone. It's still in your account. Nothing actually happened. That's why it's deemed. It's fake. So it's as though you just made whatever money you have. That's the disposition, a sale. Usually sale is income, right? Money you make, like a salary. Income is taxable. So the government just turned your assets, namely your bank account with $1 million in it, into income. Therefore, you are taxed on that income. So you pay the taxes on that money as though it were income. Usually, that will mean that you pay about half of it in taxes. The rate is just about 50% as of now, which is 2022. In Ontario, it's about 53.31. In Quebec, if my memory serves me well, lower in other provinces when you combine federal and provincial taxes. You hear people, especially doctors, at least in Quebec, complain that they pay 50% in taxes. They don't. No one does. The way the tax system works is we have what we call marginal taxes. So you pay a rate that changes with your income, but it doesn't change with your overall income. The levels that you pay are the same for everybody. So the first $15,000 or so are tax-free. And that's true regardless, this is the first kind of step, right? That's true regardless of whether you make 15, in which case you'll pay no tax, or $1 million, in which case you will still pay no tax on the first $15,000. Then there's a higher rate, higher than zero, on the following bracket, as we call it, the following step, and then it goes up again and again. And that's true for everybody, right? Even if you make $1 million, you still pay nothing on the first 15. You still pay a very low rate on the following, right, 30 or 40. And it's only when you get to making an amount that changes with the provinces, but say 150 grand, right, something like that, that you do start paying the very big rate, which is the 50 or the 53 or whatever, depending on the province you're in. So, you know, if you're a doctor, right, making, I don't know, 300, 400, 500 grand a year, you're not really paying 50%. You're making a lot of money, but you're not paying 50% on all of that. You're only paying 50% on each dollar above 150, to use my example. On every dollar under that, you're paying less, and that includes zero on the first $15,000. Now, if you're making, say, $1 million a year, in which case you're probably not a doctor, then, right, you're paying something really close to 50. Why is that? Because you've got 850 grand above the 150. So you pay 50 or 53% on 850,000 of your dollars. And then you pay on the first 150 the lower rates that everyone else pays. All that to say, when you die, to the extent that you have a fair amount of money, and right, there's got to be 10 or 20% of people who have $1 million today. So anything above, right, 600 grand or so, your tax rate will be very close to 50%, because all of your assets, to simplify things, oversimplify actually, get included in income. And so your income is really high in the one tax period, in the 1 year. So you're very likely to pay something very close to 50%. Now, question arises, right? Can I get out of paying these taxes? Well, you can commit tax fraud, but you won't do that with me, because that's not legal. The other thing you can do is gift your money. And then usually, you can tell if you've done this before, you've heard that from clients over 20 times. They just follow their chair. They're like, oh, wow, that's really cool. Are you serious? Are you sure? If you checked, I have. And I've been asked this before. And then they're like, so it's like if I just give my kids all my money, on my deathbed, it's tax-free. Like the minute before, I don't pay any tax. And then the minute after, I have to give the government another 50%, which could be millions of dollars. And then you're like, yes, that's precisely how it works. Now, that example, which is the example that 90% of people come up with when you explain that, is not actually that simple. First, it's not that easy to foresee that you are on your deathbed. Right? And usually you're not in a physical and mental state to have as your topmost thing of mind trying to get out of paying your taxes. You know, you might, but probably won't. Second thing is, I would strongly advise against doing that as a general rule, because that's my job. I have to protect my clients, right? And that means telling them that even if they don't like to hear it. And the reality is, if you've got, say, $1 million or $2 million, and you give that to your kid, right? You've worked really hard for that money, and it keeps you financially secure through retirement, which is a good thing. And usually for the same reason, namely that you've worked very hard for that money, you're very keen not to have the government take another half of it. However, if you give the money to your kid, the reality is you're no longer financially secure. There is a possibility that your kid, once you've given away the money, will not pay for your hospice or hospital care. And then people will say, but it's my kid, right? Yes, I understand that. It might be very unlikely, but my job is to flag the risks and protect them from the risks. And I would very strongly and repeatedly emphasize that it is unwise to take such a risk unduly, right? To save money in taxes, especially taxes basically someone else will pay. Now, there's a million ways to do something in between. But as a general rule, it is not wise to give away all of your money before you die, because it puts you at risk and at a time where you are generally, by definition, already vulnerable. Last thing I want to emphasize is, this all works well if it's an actual gift. Now, there are a bunch of other rules that, you know, we don't really want to get into in something simple like this. One rule, though, to remember before I get to my last point is that usually your spouse is tax-free. So you can give all your stuff to your spouse. If it's not, you know, your kids or someone else, it's your spouse, you're fine. Usually the taxes will not disappear, because they never do. They will be what we call deferred, namely pushed back in time. And the spouse will be taxed when they die. So, you know, they had 2 million, you had 2 million, you transfer your 2, now it's tax-free for now. That's what deferred means. And then when second spouse dies, they'll be taxed on that. So usually between spouses, it's not a problem, but usually the problems that do arise with death, right, are generally for people who have joint estate planning or are far more concerned about what will happen when they both die, right, or want to transfer that money to someone else in some way. So my last point is, this all works, again, all the assumptions we've just made, if it's actually money that you have already paid taxes on. So this is using an example where you made money, right? You make 200 grand a year. Pay taxes on that, then you save it up. As I said earlier, you've already paid the taxes on that. And then, right, you gift that to someone else. If it's not money that you've already paid taxes on, you're going to get into all sorts of trouble. Why is that? And we should have a video on that if I find some time, right? Because it's like the most commonly used phrase in a tax practice tailored at professionals. So, doctors, lawyers, whatever, people who make 1, 2, 3, 4, 500 grand a year, save up 1, 2, 3, 4, $5 million for retirement. And that is related party transactions. What is that? Well, it is what it says. Party is someone, so some entity or person. Usually that means a company or a person. Related means related. So someone or something that is related to you. Usually that will mean your company, which is related to you because it is yours, your spouse, your kids, and the trust company, whatever entity of the aforementioned people. A great way conceptually to get out of paying your taxes, usually, speaking generally now, no death, is to use a related party transaction. I'm going to give you an example, which again is something you encounter a lot when you do the kind of practice I just mentioned with professionals, right? They come into your office and they say, I just had this tremendous idea. I'm going to pay my wife. And, I was making 200 grand a year, which means I paid the 50% tax on the upper 50 grand. But now if I give it to my wife who makes $0, we'll each make 100. And the overall tax that we'll pay will be much lower because we'll fall into lower brackets, right? The first 15 is free and then tax rate goes up progressively. That is correct. That's how the tax system works. But of course, right, very respectfully, you're not the first person to have thought of that. Lots of people did, and then the government outlawed it. So that is prohibited. You can pay your spouse to be your secretary if she's your secretary and you're paying her a reasonable salary for that. You can't pay her to do nothing because that is a way to use a related party, namely your spouse, to get out of paying your taxes. The other thing you can do is sell something for less than it's worth to your spouse, which is again a way to defer or transfer a future tax. So say you buy a house is a bad example because usually it's tax-free, but a cottage for 500 grand, right? You project that it will be worth $1 million. Well, you just made 500 grand. That is income, money you made like a salary. You got to pay taxes on that. But it's not like a salary. It's what we call a capital gain. So it's 50% off on the tax. That's what capital gain means. So you project that. So what'd you do? Well, now that it's worth $1 million, you got this really smart idea. You'll sell it to your wife for 500. And then your wife will sell it, and then she'll get taxed on the 500, which might be more advantageous because she makes no money, right? Very rough example there. Again, related party transaction to get out of paying your taxes. These examples don't work because what you're trying to do is transfer a tax liability, transfer taxes that you owe or will owe to someone else for the purpose of lowering that tax liability. And there's very, very complex rules as to who's a related party, how you do the math, how you tax it. But the general principle is that it's not permitted. The government will notice that and will act as though it never happened. So it will just say, well, you transferred the house to your wife. We won't cancel the transaction with the notary. But for tax purposes, we will act as though it never happened. So we will say, well, yeah, the wife just made the 500 grand profit, but we'll attribute it, that's the actual word they use, to you for tax purposes. So the gift thing, the magical gift thing when you die, only works if you're talking about money that has already been taxed. If you are not, it doesn't work. So if it's money you're trying to get out of your company, If it's profit on an asset, for example, a cottage, that is yet to be taxed, the gift thing will not work. Because although it otherwise would work, now it turns into a related party transaction, which is then subject to all of these tax avoidance rules that I just mentioned. And hopefully that was not too disorganized and made some sense. And that's it for what happens as paying taxes when you die.